people. So let's start our AS5 ka revision. Sir, AS5 talks only about 5 components, I could say. Extraordinary items, exceptional item, prior period item, change in accounting policy, change in accounting estimate. That's it. Only these 5 are the scope of AS5. Okay. All right. If you just cover these 5, and it is done. First, ordinary items means what? Those income and expenses which you normally incur as part of your day-to-day operation. Like for, if you look at us, for an academy like ArivuPro, what do you think is a normal expenditure? Teacher cost, rent, other employee cost, blah, blah. All these are what? Something different or normal expected? Normal expected, yes, no. The fees that we collect from the students, all these are normal income. They are ordinary items. Now there is something called extraordinary items. Extraordinary items means something which is very different from ordinary items. Something which is very different or distinct from what? Ordinary items. Like a building got destroyed by fire. That happens every day. Yeah. A building getting destroyed by fire is totally out of the blue event or completely different event. That becomes an example of what? Extraordinary. Suppose you did not pay tax. Government took away one of your property. That we say property getting attached. Since you did not pay tax, so government attached one property. So those are some of the examples of extraordinary items. Sir, why should we know this, sir? Sir, if it is extraordinary items, sir, extraordinary items could be on the income side or it could be on the expense side. Doesn't matter. If it is an extraordinary item, you have to show it separately in your P&L. Like here, this is actual. In fact, what is the order of P&L according to you? You tell me. P&L ka format. Revenue from operations, so other income, total. Then cost of material consumed, purchase of stock in trade, changes in inventory, EFDO, employee benefit expense, finance cost, depre amortization, other expense. Then profit before tax, less tax, profit after tax. You ate away a few things. Actual format is this. This is your normal thing that you did, right? After this format, what you're going to get is profit before exceptional and extraordinary items. Exceptional items, extraordinary items, has to be shown. That is also continuing, discontinuing operation. We'll talk about that later. Leave that. Okay, but in our majority of the problem, all this will not be there. Hence, we'll stop here only. Okay, now, sir. So, if you have any extraordinary items, that has to be shown separately in your P&L. Okay, because so that the user can understand financial statements better. One. Now, this is over. Second one, over. Second one, what is the second one? Exceptional item. Exceptional item means they are ordinary items only. They are ordinary income and expenses only. But their nature or size is such that if you show it separately, users will understand financial statements better. They are ordinary items, but their amount and their nature is such that if you show it separately, user, whoever is reading financial statements, they can understand the financial statements better. Like examples, write down of inventory. Now, just now we have covered AS2. How should the inventory be valued? Cost or NRV, whichever is low. Okay, let's say cost of the inventory is 100. NRV is 80. So inventory will get valued at what? 80. Yes, sir. But you purchased inventory for what value? 100. That means currently inventory is shown at 100. From 100, you need to bring it down to 80. So you are reducing one asset by how much? 20. That we call it as inventory write down. Inventory write down. Right? It can happen, right? No, it can happen for every business. Is this totally extraordinary or part and parcel of business? Part and parcel of business. But if you think about it, inventory is one of the big ticket items because company ka major revenue comes how? Purchasing and selling goods, right? No. So if goods ka value, if it is reducing, see you purchased it at 100, but its value is only 80. Is this a good sign or a bad sign? Because you are purchasing it at 80, but the selling price is only expected to be 80 that means the business is suffering some problem is there in the business. It could be economic problem or it could also be a business problem also. Don't you think as a user of financial statement, you would like to know this? Yes, as early as possible. So hence we say write down of inventory. In this problem, how much did we write down? 200. This is an exceptional item which you will have to show it in your P&L separately. So that user can understand that there is some problem with the business. And accordingly, they can take whatever decisions that they feel appropriate. So it is not extraordinary. It is just that show it separately so that it will help the users. Some example. Similarly, sale of a long-term investment. Sir, when you sell a long-term investment, usually long-term investments and all, people don't sell that easily. Like here, holding company, do you think they will sell subsidiary company ka shares? But this year they sold off. That means some problem is there, right? So better show those items separately so that user can understand financial statements better. They are all some of the examples of exceptional item. What I would suggest is for everything, remember 1 or 2 examples, because sometimes those questions also have come. Give examples of extraordinary, exceptional and all. So know 1 or 2 to be on the safer side. Usually they will ask you to identify. Once I think they asked you for an example. So better to know that. Done. 2 over. What is that? Extraordinary, exceptional. Then third one is a prior period item. Name itself is saying prior period. Prior period means it relates to current year or previous year or previous years. Which year we don't know. So prior period item means they are items of income and expenses that are appearing in the current year. Prior period items are items of income and expenses that are appearing in the current year, but they don't relate to current year. They relate to previous years. They relate to previous years, but they are appearing when? Current year. Why? Because there was some fraud or there could be some omission. When you prepared previous financial statements, there were some errors or fraud. You detected that in the current year. Now, when you detect a fraud, will you keep quiet or correct it? Correct. When can you correct? Last year is already past. Can you take eraser and erase financial statements ka data? No. That means you can correct it only which year? Correct. So prior period item relates to previous years, but that correction can be done only in the current year. They are prior period item. Example could be some expense missed out, some fraud detected, some theft detected, whatever. All those are examples of what's a prior period item. If you have a prior period item also should be shown separately in P&L. Those are the requirement. Meaning, and this is the what you need to do. Action points. That's it. Next, 4th one, accounting policy. Sir, accounting policies are basically rules. Accounting policies are basically rules which are applied to prepare the financial statements. Okay, like now for AS 10, there are 2 ways of doing subsequent recognition. What are those? Initially, everything will be recognized at cost. Subsequently, either you will go for cost model or revaluation. Can you do both or you have to select one? Both will give same impact or different impact? Different impact, right? So that is an accounting policy. You have to select one, and whatever you have chosen becomes a rule. Okay, so that's nothing but unless you select one, can you prepare your financial statements properly? No. So accounting policies are basically certain principles or rules which you have used to prepare your financial statements. Like you have your inventory valuations, FIFO or weighted average. So those are all your accounting policies. AS1 and AS5 it like overlap. This comes here also, same thing comes in AS1 also, same ditto. Yeah, correct only. Now people, I'm saying accounting policies are rules. Rules can be changed frequently. Today when you go into traffic light, green means go, red means stop. Tomorrow, red means go, green means stop. Will it work out? No. Rules around should be followed consistently. Only then it will give you the desired results. So accounting policies usually should not be changed frequently. There are only 3 conditions or criteria under which an accounting policy can get changed. 1, it is a requirement of a law. Suppose you are following FIFO method. Modi one day come, Modi sir came and told, Mitro, FIFO banned. Now what you will do? Can you follow FIFO or you have to change? Change, because it's a requirement of a law. So if law says you cannot apply that policy, compulsorily you will have to change. Second one, requirement of a standard. If accounting standard says, accounting standard bans LIFO, last in, first out. So initially LIFO was acceptable. I think few years, I don't know how many years back, LIFO got banned. When LIFO got banned, can you still follow last in, first out method or change? Change, because it is a requirement of what? Accounting standard. This is one. Or for better presentation of financial statement. It's not or, it's not and, okay, all. Any of the three are okay. Or better presentation of financial statements. If directors feel by changing accounting policies, it will lead to a better presentation of financial statement, you can change it. Okay, now that is you'll have to convince your auditor also why it leads to better presentation. Okay, Ji, like let's say I am a unlisted public company. I am what? Unlisted public company. I am following for my PPE cost model. I am following what model? Cost model. But all my competitors are listed companies. Their shares are listed in the stock exchange. They are all following revaluation model. They are all following what? Revaluation model. Now, my company also I want to list. My company also I want to list in the stock exchange. Now, I feel if I change my policy from cost model to revaluation model, I can compare my financial statement with my competitor financial statements better. Does it lead to better presentation of financial statement? Then you can change. Those are some of the examples of better presentation. Is this okay with you? These are subjective. If you can convince the auditor that by changing accounting policy, it will lead to a better presentation of financial statements, you can do so. These are one of the three conditions should come in for you to change your accounting policies. Otherwise, it should not be changed. That is one. Another one is, sir, whenever you change an accounting policy, it has retrospective impact. It has retrospective impact. Retrospective impact means from the beginning, you will have to recalculate. Like here, let's say PP. From year 1 to year 4, you have followed cost model. Year 5, from cost model, you want to shift to revaluation. Revaluation model means what? To show the asset at fair value. Value will change. Now, you can't only calculate for year 5. Accounting policy has what impact? Retrospective impact. Retrospective means what standard is saying is from year 1. From year 1, if you had followed revaluation model, what will be the value of the asset? Find that out. That's what we mean by retrospective impact. From the beginning, you need to work out and give its effect in which year. So that's what we mean by and you don't have to worry at your level, but this is a important concept in CA final. You can get some good questions out of this. Okay, because ASK, Ind-ASK, there is something not required. Okay, for now, I think if you just remember the wordings, it is good enough. Accounting policy has what impact? Retrospective impact. Retrospective means you'll have to calculate. Here, though you have changed the policy in year 5, can you only calculate for year 5 or from year 1? From year 1, if you had followed revaluation model, what would have been your PPE ka carrying amount? You have to find that and give its effect in which year? Current year. That's what we mean by giving a retrospective impact. Another, this is important. Couple of times this has been asked in the papers. So if you are adopting a new accounting policy, it is not considered as a change in accounting policy. Like earlier, I had no pension scheme. Earlier, I had no pension scheme, no gratuity scheme. This year, I brought in a formal pension scheme. I brought in a rule, whichever employee completes 5 years will get pension. I brought in a formal policy saying whichever employee completes 5 years will get a pension. Earlier, did I have a scheme or no scheme? Can I say I have done a policy change? I have done an accounting policy change? No. If you want to say that you have done an accounting policy change, no, something should already be existing. Existing policy, if you have replaced with something else, then we say you have done a policy change. Earlier, what was my policy? Did I have a policy or no policy? So if you adopt a new policy altogether in the current year, it is not a change in accounting policy. Okay, Naji? Fine, sir. Sir, what should we do for accounting policy change, sir? That is same as accounting estimate. That is covered in the next chart. I'll tell you. Okay, last one for AS5, which is accounting estimate changes. So accounting estimates are basically certain judgments or approximates used to prepare financial statements. Like a particular property, plant and equipment ka useful life is 7 years. A particular property, plant and equipment ka useful life is how much? 7 years. 7 years, pakka number or just an approximate? Just an approximate. Residual value I am thinking is 1 lakh. Pakka number or just an approximate? Finally, I may get more than 1 lakh also, or I may get less than 1 lakh also. This is just a what, sir? Approximate. Such approximates only we call it as accounting estimates. Now, if I don't use estimate, then I will not find out how much is useful life. I will not know how much is residual value. If I don't know these two information, my depreciation will I know, or you will not know? If you don't know depreciation, will you know PPE ka closing balance? No, that means can you prepare balance sheet? That means to prepare financial statement, certain approximates are also necessary. That approximates only we call it as what? Accounting estimates. SSRO. And now this is one. Now people, estimates, since they are not pakka number, can estimates change? Can estimates change? Yeah. Sir, initially when I bought the asset, I thought I will use it for how many years? 7 years. First month only, no, my asset got physically damaged. No, due to whatever reasons. First month only, I bought it. When I bought it on day 1, what was the life expected? 7 years. In the first month only when I bought the asset got physically damaged. Now can I say I will use the asset for 7 years? No. Now I feel I can use the asset maximum for 3 years. That means my estimate is becoming same, or it is getting revised? Revised based on what? Circumstance. Yes or no? Accounting estimates are always based on what, sir? Circumstance. If that circumstance changes, then estimates can also be changed. Possible, no? Like that. Estimates can be changed. When I say change, it's not necessarily reduction. It could also be increase. That could also be a possibility. Yes, change can be either positive side or on the negative side, favorable or unfavorable. But since estimates are based on certain factors or circumstance, if those circumstance changes, estimates can also be changed. Okay. Now, do you think it is my fault? Do you think is my fault entirely? No, it can happen, right? Yes. Or maybe take another example. Sir, when I bought the asset, I thought I will use it for how many years? 7 years. 1 year over. 1 year over. So remaining life should have been how much? 6 years. But Modi sir came and said plastic banned. Plastic banned. But I am using a machinery to produce plastic. I am using a machinery to produce plastic. My plastic cover, can I sell it now or banned? Banned. That means now can I use it for 6 years or I cannot? I cannot. Is it my mistake or a technological, or it's a law change? Can I be penalized for that? See, accounting policy change, how will you give the effect? Retrospectively, meaning from the beginning. Accounting estimate also, can you ask me to do it from the beginning? Would that be fair? Estimates are always based on what? Circumstance. And circumstance will always keep changing. So circumstance will only change once, or it can change multiple times. Multiple times. That means every time I'll keep doing retrospective. In standard says accounting estimate change are always applied what? Prospective. Meaning, if estimate changes in year 3, then should you have to worry about year 1 and year 2, or you don't have to worry? You don't have to worry. Whatever you have done is gone. You only have to worry about which year now? Year 3 onwards. Previously, what you have done is not your botherations. You don't have to worry about that. That's what we mean by prospective effect. Now, last part to disclosure. So this disclosure is same for accounting estimate as well as it is same for accounting policy. Sir, whenever you change an estimate, like here, if life changes, if life or residual value changes, depreciation will be same or depreciation also will change? Depre also will change. What about the PP ka carrying amount? Will that be same or it will change? It will change. Yes, no, correct, no. That means what the standard is saying is, whenever you change an estimate, your financial statements will get impacted. So first check whether it is a material impact or a small effect. It's a major effect or a small effect. If it's a major impact, then ask yourself this one question, whether that major effect is felt in the current year or future years. Due to estimate change, your financial statement is majorly getting affected in the current year or future year. If the answer to this question, if it is yes, then you will have to disclose this fact. In your notes to accounts, you have to give a disclosure. What disclosure? I have changed an accounting estimate. Due to this change, my balance sheet value is changing by so and so. My PPE in balance sheet is changing by this much. My P&L is getting affected by this much. That effect you need to mention in notes to accounts. Okay, Saru. Suppose you have changed an accounting estimate, but the effect is very immaterial. You have changed your useful life, but due to this, from 1 lakh depreciation became 1,05,000. From 1 lakh depreciation became 1,05,000 and minus 10,000 crore organization. How much is my size? 10,000 crores. I am Reliance. Do you think this is material for me or immaterial? So if it is not a material fact, you don't have to give any disclosure. If it's a material impact in financial statement, either in the current year or next year, you have to disclose a fact that you have changed an accounting estimate, as well as how it affects your financial statement. That also has to be disclosed. If, however, if there is insignificant effect, means no disclosure is necessary. Or another way, sir, you have changed your accounting estimate. Due to this, your financial statement will get materially affected. But how much you are not able to quantify, you are not able to find out. If you are not able to find out, then you tell that only. What you will tell? I have changed my accounting estimate, but due to this change, how my future financial statement is going to get affected, I am not able to find out. Such a disclosure only you give it in your financial statement. This disclosure applies for accounting estimate as well as accounting. See. Okay. Next, silence, I understood. Okay, question. Fine. A company finds that inventory sheets, inventory pages of 31st March 2016 did not include 2 pages containing inventory details worth 14.5 lakh. Inventory storekeeper Mahanubhava Bruhaspati, you probably didn't pay him salary on time. You know simply what he did? 2 sheets of inventory, he tore it off and left. And the 2 sheets had how much inventory value? 14.5 lakh. That means your inventory valuation is correct or wrong? Wrong. How will you deal with the following matter? They are saying, okay, what is this? And first of all, check inventory sheets of which year? For the year ending 31st March 2016. Now they are saying, how will you give its effect in 31st March 2017? So what is the question trying to say? Sir, error happened in the last year, but you came to know about it only in the current year. So what is this? And you know what to do for prior period item. What is it? Give a disclosure separately. That's all. Okay, this one. Question number 8 of our class notes. They'll give you like 5 points. You need to tell what is it. Provision. Sir, I don't have to read. The moment they say provision, I don't even have to go further. Provision is pakka number or approximate. Means what is this? Estimate. That's what they're saying here. You already made a provision of how much? 2% till 31st March 2016. Sir, currently you are in 31st March 2017. Till last year, you made provision at what rate? 2%. Currently, you have made it at 3%. Is it policy change? Sir, provision is based on what circumstance? Last year, I would have, maybe my debtor was okay, was decent enough. So, I made only how much percent provision? 2%. This time, my debtor is showing Mr. Sri Malia signs. So, from 2%, I increased it to how much? 3%. Have I done anything wrong in the previous year? No. These are purely based on what? Circumstance. Provision is always a approximate. So this is what? This is a change in accounting policy or accounting estimate. Accounting estimate. During the current year ended 31st March 2017, management has formally introduced a gratuity scheme in place of ad hoc ex gratia payments to employees on retirement. Ad hoc means management, whatever they felt, they used to do it till now. Meaning some employees they will give gratuity. Some employees face cut they don't like, so no gratuity. That they used to do. That's what we mean by ad hoc. Till last year, that was the plan. Now they've introduced what? A formal scheme. Is it a change in accounting policy? First of all, did you have any plan in the last year or no plan? Ad hoc is not a plan. Ad hoc means what I said over here. That is not a plan. Earlier there was no plan. Now you brought in a new plan. Is it a change in accounting policy or not a change in accounting policy? Not a change in accounting policy. Depreciation. I don't have to read anything further. Depreciation is always based on useful life and residual life. And both are what? Estimate. So depreciation is also accounting estimate. And moreover, accounting standard 10 said depreciation method should be based on pattern of economic benefit. If benefit changes, you can change your method of depreciation also. So depreciation is always a change in accounting estimate. Okay. Okay. Management decided to pay pension to employees who retire after 5 years. Earlier we had no scheme. Earlier no scheme. Now they brought in a scheme. It is a change in accounting policy or not a change? Not a change. During the current year, there was a change in cost formula. Cost formula means maybe you went from FIFO to weighted average or vice versa, right? If you change this is what? A change in accounting policy. And accounting policy changes always has what impact? Retrospective application, meaning you all have to recalculate from the beginning and give its effect in the current year. That's it. Thank you.